Between 2003 and 2006, American banks gave mortgages to millions of people who couldn't repay them, sliced those mortgages into pieces, sold the pieces as investment products to pension funds and sovereign wealth funds across the world, and had the products rated AAA by agencies paid to rate them. When house prices stopped going up, the entire structure collapsed. 8 million people lost their jobs. Not one senior banker went to prison. Let's rewind to how the machine was built. Housing prices in America had been rising for a decade. The Federal Reserve had kept interest rates unusually low for years. Money was cheap, credit was easy, and the American dream, the house, the yard, the garage, had never felt more accessible. Mortgage lenders noticed. If you could get someone to sign a mortgage, you earned a commission. Whether they could pay it back wasn't really your problem. Your problem was originating the loan and selling it to a bank. The bank's problem was selling it to investors. The investor's problem was selling it to someone else. Everyone earned fees at every stage. Nobody planned to hold the risk. Banks packaged thousands of individual mortgages into a single product. They called it a mortgage-backed security. The idea was that even if some borrowers defaulted, the others would keep paying. In theory, the lenders kept lowering the bar. No income verification required. No down payment required. Adjustable rates that started low and ballooned later. Mortgage brokers sold what became known as ninja loans. No income, no job, no assets. Banks bought them anyway. The products needed ratings. Rating agencies, Moody's, Standard & Poor's, Fitch, assigned letters to financial products to signal their safety. AAA was the highest possible rating, safe as government bonds, and the rating agencies gave AAA ratings to bundles of mortgages that contained loans made to people with no income, no job, and no assets. They did this because the banks paid their fees. Rating the products AAA kept the fees coming. The machine had one requirement. House prices had to keep rising. If prices kept rising, even borrowers who couldn't pay could refinance or sell. The machine never priced in the possibility that prices would fall. They fell. In 2005, a physician-turned-hedge fund manager named Michael Burry read thousands of mortgage documents line by line. He was the first person in finance to do this systematically. What he found was that the loans inside the mortgage-backed securities were far worse than the ratings suggested. Borrowers had adjustable rates set to reset in 2007. When the rates reset, the defaults would begin. The securities would fail. The house of cards would fall. Burry called his broker at Deutsche Bank and asked to buy insurance against the collapse of the housing market. His broker, a trader named Greg Lipman, thought he was crazy. Then Lipman read the same data and bet the same way. A small group of investors had figured out what the entire financial system had not. While the banks were packaging and selling and collecting fees, a handful of hedge funds were quietly purchasing credit default swaps, essentially insurance policies, on the mortgage securities, waiting for them to fail. The banks who sold them this insurance were AIG Financial Products. AIG charged tiny premiums because they believed the securities would never fail. They never modeled what would happen if housing fell nationally. They collected billions in premiums with no reserves to pay claims. Joe Cassano, who ran AIG Financial Products, said in August 2007 that he could not envision any scenario in which AIG would lose a dollar. He said this approximately 1 year before AIG required a $182 billion government rescue. Inside the major banks, people who raised concerns were ignored or reassigned. The bonus structure rewarded volume, not quality. You were paid for what you sold this year. What happened in 3 years was somebody else's problem, usually the pension fund's problem. The ratings agencies continued to stamp AAA on anything brought to them. The mortgage brokers kept originating loans they knew were bad. The banks kept slicing and packaging and selling. The machine ran at full speed because everyone at every stage was making money right now. Nobody was responsible for what happened next. In 2007, the adjustable rate mortgages began resetting. Borrowers who had been making manageable payments suddenly owed significantly more per month. Defaults began climbing. The securities backed by those mortgages began losing value. The system that had been described as too sophisticated to fail began, quietly at first, to fail. March 2008. Bear Stearns, one of Wall Street's oldest and most storied investment banks, was insolvent. The Federal Reserve arranged an emergency sale to J.P. Morgan Chase at $2 per share, a bank that had traded above $170 per share a year earlier. $2. The Fed provided $30 billion in financing to make the deal happen. Nobody believed a bank as large as Lehman Brothers could be next. The 14th of September, 2008. Lehman Brothers, 158 years old, the fourth largest investment bank in America, is out of options. Treasury Secretary Hank Paulson has decided the government will not bail it out. On September 15th, Lehman files for the largest bankruptcy in American history, $613 billion in debt. The global financial system seizes. Money market funds break the buck. Commercial paper markets freeze. Credit stops flowing. Banks stop lending to each other because no one knows who else is holding toxic securities. The word contagion appears in every newspaper. AIG requires $182 billion in government rescue funds, the largest bailout of a private company in history. The U.S. government launches the Troubled Asset Relief Program. $700 billion authorized to stabilize the banking system. In the United Kingdom, Iceland, Ireland, and Spain, governments intervene in their banking systems. The crisis is global. The stock market loses 57% of its value peak to trough. Home prices fall more than 30%. 6 million Americans receive foreclosure notices. Unemployment reaches 10%. The machine that had been printing fees for a decade stops, and the people who had been standing behind it look for someone else to blame. Congress passed the Emergency Economic Stabilization Act in October 2008, authorizing the bailout. Congress passed Dodd-Frank in 2010, adding new regulations to the guest and the financial system. The Obama administration prosecuted financial institutions and extracted tens of billions in civil fines. J.P. Morgan paid $13 billion. Bank of America paid $17 billion. Goldman Sachs paid $5 billion. The fines went to the Treasury, not to the people who lost their homes. In terms of individual criminal accountability, the record is striking. One mid-level banker at Credit Suisse, Karim Sarageldin, served 2.5 years in prison for mismarking bond positions. He is the only senior financial professional convicted of a crime directly related to the 2008 crisis in the United States. The CEOs of Lehman Brothers, Bear Stearns, Merrill Lynch, Citigroup, Washington Mutual, and AIG were not charged. Many received severance packages measured in tens of millions of dollars on their way out. Dick Fuld, the CEO of Lehman Brothers, earned approximately $500 million during his tenure. He testified before Congress. He was not prosecuted. He later said he was still puzzled about what happened. The housing market eventually recovered. The banks, recapitalized and restructured, became more profitable than ever. The 6 largest U.S. banks are significantly larger today than they were in 2008. The problem of too big to fail was not solved. It was made larger. What changed? Slightly higher capital requirements, better stress testing, more paperwork. The fundamental incentive structure: originate, sell, collect fees, let someone else hold the risk, is embedded in the architecture of modern finance. 8 million people lost their jobs. 3 million lost their homes. Retirement accounts evaporated. Neighborhoods emptied. And then, in Washington and on Wall Street, almost everyone involved moved on. The machine needed new parts. It found them.